Here we go. All right, good afternoon, everyone. Today is Wednesday, the 26th day of February 2025. It is now 3:01. So, what I wanted to go over today. Well, first, this was today in the room. The 6 trades, that was yesterday afternoon. But that was what we did in the room today. Now, when I say in the room, TV Trades does not have a room that I trade in. Okay, we just have this meeting on Wednesdays. As long as I can make it on Wednesdays, we'd have this meeting on Wednesdays. Sometimes I might need to shift it to a Tuesday or a Thursday, or not at all, like next week. But but the room that I trade in is at mytradingiq.com, and I've been doing that room for years and years. I use a watered down version of the TV Trades range trigger. Okay, what I do in there, you guys have access to, but this is better. So let's just go here. If you haven't taken a trial with us, go here to tvtrades.com, sign up for the trial. This is what it is after the 3-day trial. This is what it is after. On a weekly, it's $25. On a monthly, it's $90. On a year, it's $9.97. The year actually worked out to be the very best one. I think that works out to be like 80 something bucks a month or something like that, if you do it by the year. Anyway, that's the deal. The weekly is the most expensive, but a lot of you guys start out with the weekly because you want to get a feel for it first, and I don't blame you. All right, so the stuff that I wanted to go over today, look at all these nice alerts coming up here. You see that? You guys all have access to that now. That's one of the things that I want to go over today is the alerts. Okay, from the trade alerts, this alert at 11 in Q1. This trade, the alert 11:58:14 for NQ1. List to sell trade current price. If you're on the NQ1, you're not on the same contract as me necessarily. Okay, list to sell trade current price, or that's probably not the same thing as what the NQH is showing. You can send me a screenshot if you want on that, Larry, though. Yeah, send me a screenshot. But if I have the alert going off the NQ1, let's see what alert you are talking about. It was at 11:58, you said? An 11:58 alert. A lot of alerts in here today. Yeah, this is it, right? These are all. Of course, I have alerts for everything going off from this account, so you guys don't see all the alerts that I have going off. And that is your alert that you set up. I don't think I have anything going off from the NQ1. Now you see I have NQH. If you're doing it from the NQ1, it's not going to be exactly the same as mine, but you can send me a screenshot. Okay. The NQ1 should be the leading contract. It should be the same as the NQH, but there are going to be times where it's not. All right, so let's get into what I wanted to get into first. Okay. I wanted to cover the 3 different types of chop, right? And in this document that I had created last week about trailing stops, I kind of list 3 different types of chops in here, right? This kind of chop, the bugle chop, the triangle chop, and the channel chop. And we had all those today on the ES. And I'm going to show you examples of that, because when you're trading in chop, this is the worst. The bugle chop is the worst to trade in, because you don't really have any defined support or resistance in bugle chop. It keeps expanding on you, and so you don't know where it's going to stop. The triangle chop is better because you do have defined resistance and support, but it's diminishing resistance and support. You don't know which one's going to break. The channel chop, which is, we had some good channel chop today. That's one that I like the most, is the channel chop. We had some good channel chop today, so I'm going to go over some trades that I took in the channel chop today. Okay, so there's 3 different kinds of chop, and if we get into this over here, hang on, let me move this over, Larry. Mine are different by Telegram trade future signals. Okay. Have I fixed? What bugs are you talking about, Abe? Let me just go down. Your NQ doesn't show any bar profit numbers before 1:30 p.m. Yeah, I don't know why it does that. Mine doesn't either. See, mine's right there. Mine doesn't either. I don't know why it stops doing that. That's not anything that I wrote into the code. Okay, I'm going to try to figure out why it does that. It should keep going, for hours beyond that. days beyond that. But for some reason, it just stops going right there. I don't know why. And it's not just, I mean, this is the S. You were saying it about the NQ, I think, right? It's like it does it a limited number of times, and it doesn't make any sense. It's not written in the code that way, I can assure you that. Okay, so let me get through what I want to get through first, and then I'll get through all your questions and all that stuff, okay? So first, I want to talk about the different kinds of chop, right? And how to trade in different kinds of chop, because some of the things that you guys have been sending me emails about over the week are how to trail the stop, how to manage your risk, and how to trail stops, and that depends on what kind of a market that you're in. One of the things that you can do, if you just take a look back, when you have this on the TV trades, when you have these profit numbers on here, you can just take a look back and see if there's follow through in the market. And that's, these are all generated from the optimum trigger. So you can see, just take a quick look back and see if there's follow through. Are you going to hit break even on most of these or better? And those are just the actual trigger bars. If you get a 3 like this, you got to look at it and see, did it keep going in that direction? And it did. If you get a 0 like this, would you have stopped out? Well, yeah, you would have on that one for sure. But on a 4, would you have gotten more? Yeah, you would have. On a 1, did that keep going in that direction or not? It didn't. So you got to look at that kind of thing and see if you have follow through with the trades. That's a simple process that you can just throw this on and say, okay, I got a 7 tick range. I move the stop to break even after 4 ticks in profit. How many of these are less than 4? If they're all less than 4, then you might not want to trade that market in that time frame at that time. You can change to a different time frame. You can just bump it up to a larger time frame and see what it says there. And see, with the larger time frame, like on the 19 or the 20 range, I moved the stop to break even after 10 ticks in profit. How many of these went to 10 ticks? That's the kind of thing you got to look at. And you got all the information right here at your fingertips now. It's really simple to see. Okay. That was one of the questions that I got today on a larger time frame on the 250 range. When you're talking about something like the 250 range, we're only going to get a couple of trades a day. You need a lot of volatility for something that large to become substantial enough for you to move your stop to break even, and then to move even additionally to take profit in the trade. You got to move it to break even after 75 to 100 ticks. You move your stop to break even. I would do it after like 40 or 50, but some people wait on the 250 until it gets 100 ticks in profit. Then they move their stop to break even, and then after 125, they'll move it to plus 50 or something like that. That's up to you how you want to do it. I don't really have a formula for that. If you guys go here, I want to show you. I put this on TargetViewTrades.com, TargetViewTrades.com. If you go to TargetViewTrades.com, in here, go to More and Risk Management. This is the stuff that I put in here for the risk management, okay? Now, you guys have all seen that. Well, not all of you, but anybody that hasn't seen that before, you can go here to see it. This is how I manage my stops, how I manage my trades. Down here, I put this right here. I also put it in here, so you can come down here and look at it if you want to and read it here. And you can download the PDF. If you want to download the PDF, you can do it from right here, okay? The risk management that I do, you can see that the bigger it is, the smaller the stop I have with regard to the bar size. Like in here, a 7 tick range has a 10 tick stop. That's almost 50% of the bar size. All right, it's 3 ticks bigger than the bar, and 3 ticks is almost 50% of the bar size. A 9 tick has a 15 tick stop. That's 4 ticks. I'm sorry, 6 ticks. That is more than 50% of the bar size. And 11 ticks still has the same 15, but that's less than 50% of the bar size. But the bigger you get, the more likely it is to be a pivot bar. Okay, the bigger the time frame that you're in, the more likely it is to be a pivot bar. So the less additional risk you need on top of it. Like this is 10% bigger than the bar size, as opposed to 40 or 50% up here. So when you're talking about a 250 range, you do something like 225. That's 10% more, right? That's 10% more than the bar size. And in this one, I trail the stop to break even after 40 ticks in profit on a 100. So it goes 40%. And then trail the stop to break even. You could do the same kind of math if you want to do the same kind of math with the 250. It would be about 100 ticks you move your stop to break even. Maybe you could do a little less than that, but 40%. 40% would be 40% of 250. That'd be 100 ticks. It would be 100 ticks. So, I mean, if you want to do it that way, that is something you can do. And then, it has a 150 tick profit target, but you can set your profit target at whatever you want. The ideal settings for the S and the NQ, if you just want a base hit. Well, in the mornings I use a 7 tick range, and lately I'm using a 50 tick range because there's been a lot of volatility in the NQ. But I use a 31 or a 50 tick range on the NQ for the base hits. Abe. Okay. And the stuff that's in Telegram, Larry, those may be the NQ1 stuff. Because I didn't want to have to go back and change all of that. So if you put your charts on the NQ1, or my charts on the NQ1, if I were to compare the NQ1 to those, they would come out to be the same. But I stick my charts generally on the NQH. The reason I do that, Larry, is because the stuff that I don't want to have to recreate, at the end of every quarter when we get when we roll to the new contract, there's a lot of alerts in here. You see, there's a whole bunch of alerts in here, and I don't want to have to go back and recreate every one of those at the end of every quarter. That's why I started using the continuous contracts for those ones. Okay, I did do some on the age contract here, but that's stuff that I'm testing right now. It's not stuff that you guys are going to be interested in at this point. Well, you probably are interested in it, but that's why that's a little bit different, Larry. Okay. And so if you're going to go by the alerts, if you're going to trade by the alerts that say NQ1, then you have to set your chart to NQ1 and trade on the NQ1 chart. Okay. I only put it on NQ1. Like the NQ1 might not match the ES1 exclamation point might not match up directly with the with this one. If I put them side by side right now, let's do this. I'll do well, if I do this and I make this in ES and do one exclamation point, you see they don't match up directly right now. This is up here right now. It looks like 63.25. That's 63.75. I'm sorry, that's the high. So I guess they do match up pretty close, but they're off just a tiny bit, and that's going to happen. Okay, so if you're going to trade off of the stuff that's in the Telegram channel that has the ES1 exclamation point, put your chart on the ES1 exclamation point as well. Okay. All right. Let me put this back to the NQ. NQH, and we'll expand on this again. So the chop stuff. Well, I explain how to use that oscillator and all that stuff. Yes, I will, Hal. All right, let me go over here and look at the different types of chop that we have. Okay. Now, in the morning, you guys, some of you guys, those are you guys that don't go to the morning session, that don't do both the TIQ and this, that only do this, then all you see when I put those big numbers up is that the big numbers are there, but you don't see me actually put the trades on. But this layout right here has all the trades that I did this morning. For instance, all these arrows that you see, those are the trades that I took this morning to get to the numbers that we got on the ES. And you can see I had some stop outs in here. That was a stop out, that was a stop out. Those are both mistakes on my part, but I stopped out on both of them. That was a stop out. And the yellows are break evens, the blues are profit. But what I wanted to show you in here was the chop, right? The chop. When we get into the chop, this is channel chop. That's my favorite kind of chop. But let's go to the other kind of chop. Okay, let's start out with the worst. That's the second best. This right here is the worst kind of chop. Now, the reason I say it's the worst kind of chop is because you have, you don't really know exactly what's going to happen ever with the market. But with this kind of thing, the least. You can expect the least out of this. Because this, when you're in this kind of chop, this started out like that. Alright, it started out like that. And then you don't know if it's going to stop up there, or if it's going to keep going up there. As it expands, this bugle, as it expands, you don't know when it's going to start coming back down. So when you get into a trade, like let's say this right here is a 7 range ES. So when I get into a 7 range ES trade, what time is this right here? This is 1:29. Okay, when I get into a 7 range ES trade, I was hoping to go to the end and see if we could get into a 7 range trade, but when I get into a trade, I know exactly where my stop's going to be, and I know when I'm going to move it to break even. But then managing the trade after that becomes the issue, right? Now, there are certain things that you do know ahead of time about the markets, right? There are certain things that you do know ahead of time that you can use for your risk management, because you know the markets are always going to go up, and they're going to go down, and they're going to go up, and they're going to go down. And then eventually they're not going to go up far enough, and then they're going to come down and exceed the prior swing low. And that's the beginning of a trend change, right? Right there, that's the beginning of a trend change. But when you have this kind of thing right here, it goes up, and then it comes down, and it exceeds the prior swing low. So what you should get is a little move up like this, a 50% retracement of that. What you should get right there is a 50% retracement of that, and then it should go down and do another leg like that. But with this kind of chop, what you end up with is something that goes up there like that, right? So all the spots that you would normally look for it to stop, one is right here, the other is right here, they get exceeded. And then, if it's really ugly like this, it goes all the way back down here. So all the spots on the way back down that you would expect it to stop get exceeded. And that's what happened right here. You see it started out like this, and this looked normal, and it came down here, and it gave a nice trade right down here, okay, to grab a piece of this. Well, it actually wasn't that nice, because you would have entered on the open of this bar right here, and it pulled back pretty deep. But but it eventually went up. But this is the beginning of the nasty chop, right? It eventually went up, and it exceeded this. It went up here, and it faked you out right there, thinking you were going to go down from there. It actually gave you a short trade right here that got to the point where you could have gotten it to break even right there. With a decent entry, you could have gotten it to break even right there. But it said it was going to go down, and then it went up, and it exceeded it. This is the worst kind of chop, because right here you're thinking, okay, so we broke out above the top, above this level right here. You know, we didn't break out of that. They offered some support. So we're going to keep going up. So when it pulls back here, you get this right here, and you're anticipating that it's going to keep going up, right? So you take the aggressive trade right here. Now, fortunately, with the risk management that we have, if you took the aggressive trade right there, you got your stop to break even in time. Actually, it wasn't even there. It was down here. If you took the aggressive trade right there, you got your stop to break even, I think. It had to go 4 ticks into profit. 78, it had to go up to 79. 78, 75. No, that would have stopped you out. So you get stopped out right there, right? That's why this is the worst kind of chop. You get stopped out right there, and then you're thinking, okay, well, I got stopped out. Now it's gonna go down. It's gonna start moving down, and it's gonna give me a good movement down, right? But it shoots right through the bottom, like that. That's why this is the worst kind of chop. And you know, when it goes down to here, you don't have a trade set up here that you know of yet, but there's going to be one. Well, there is. I mean, there's a trade setup because it shoots through there down to the bottom, but I have something else I'm working on that goes from the middle. Anything that starts in the middle, I'm working on that for you guys. But this is, because it went into the oversold like that, that does turn into a trade setup. So you can take that trade setup here, but you had to stop out on that one first. It's the worst kind of chop because of that. And so you don't really know that you're in that kind of chop until you stop out a couple of times. It's tough to trade because you do end up stopping out. You don't know exactly how to move your stop. You know, you got to really rely on what the market normally does. That's all you can do when you're in that kind of stop, in that kind of market, in this kind of a chop. You know the market is supposed to go up to the prior swing high. So as price starts to move up, you move your stop to break even. You got to have a plan. And the plan that I showed you just a minute ago, this is my plan. That's always my plan for getting the stop to break even, no matter what time, no matter what market it is. If I'm using any of these time frames, that's always my plan for getting the stop to break even. Okay, it's always my plan for getting the stop to break even. So I get to break even, but then, you don't know what to expect out of the trade because you don't know what direction it's really going to go in. And in this case right here, this one right here ended up going through the prior swing high. Okay, so you had this trade right here, this white bar right here gave you a long trade right here, and it was right at the prior swing high, which is kind of ugly, but it ended up going up pretty nicely. The next trade was over here, and this one gave you just this little bit of a move right here. If you got a better entry down here at the bottom and you managed to get break even on that, that's good. But it's possible that it went right up there. Not likely, but it's possible that it went right up there and then went down and closed. And then it gave you this one right here. So right here you're thinking, okay, well now we're going to go short because this failed going up. So it's showing weakness and it's all going to be short. And then it goes through here, and it does look good. It gives you the short, and then it gives you another short right here. But what does this one do? This one goes up. so this is the worst kind of chop, all right? And if you're in that, if you notice it, if you notice that you have higher highs and lower lows in the market, just step away until it breaks out of that junk, because it's usually going to work out to be, some other better chop, or it's going to work out to be a trend. So I just wanted, there's no good way to trade that, really. I mean, follow your rules, getting your stop to break even, but if you notice that you're getting break even and then it's completely going the opposite direction, you can see the market is giving you higher highs and lower lows. If you see that, stop trading, because that's the worst kind of chop to be in. Does that make sense? It's, in the document in this document right here, I said I was going to start out with the worst kind of chop, and that's the Bugle Chop, this one right here. You got to trail your stop close. It's hard to predict where the tops and bottoms are going to be, so you got to use tight stops. And you don't know if it's getting to support or resistance, because you don't know where support or resistance is. When it gets up here, you don't know if it's going to act as resistance. So you got to trail your stop really tightly. Once you get it to break even, trail it really tightly when you notice that you have higher highs and lower lows. All right, or just don't trade when it gets like that. Wait until it starts to get out of there. If it breaks out of the low and it starts to give you some good channel chop, or even triangle chop. Oops, I didn't mean to do that. All right. Does that make sense to everybody? I want to cover that because it's important that you see that kind of thing in the market. The TV trades. That was a question that Dan. I don't know if Dan's in here. Dan, are you in here? Dan is not in here. That was a question that he asked me yesterday. With TV trades, you don't get a live room in the morning to watch me do it, but you get me on Wednesdays to tell you what to look for and what to expect. And I mean, you can go to the live room in the morning if you want to. You can take a free trial there if you want to. It's at mytradingiq.com. You can take a free trial there if you want to. You don't have to join. Just take the free trial if you want to see me using it. That's fine. There's no credit card required for that if you want to get into that. A lot of you guys already belong to that or have done that, so you all know about it. But if you haven't and you want to see me trading this live, then you can go there anytime. Anytime. I do it 9:30 to 11:30 every day, except next week. Next week is the first time in 15 years I'm not going to do it. But when you see that kind of market, just move to something else. All right, go to another market and wait until it gets out of that. It takes a little while. Usually it'll take it a little while to get out of that. It's got to really break through the bottom of the top and then continue in that direction. Like this right here, it broke through the bottom. First it broke through the top, gave you a head fake. Then it broke through the bottom, gave you another head fake. And then it turned into some channel chop. And so let's talk about channel chop a little bit. No, let's talk about the triangle chop first. That's the next one over. Sorry. Okay, yeah, I chose the ES today, Wayne, because it happened to me on the ES today. So I had some good examples of it. And the channel chop is great. All right. The triangle chop is not bad, because with the triangle chop, you have a pretty good idea what to expect. Right? It's diminishing chop. It's diminishing expectations of the trades as you get further and further into the corner of the triangle. But at least you have an idea where to expect the market to go and what to do. With the Bugle Chop, you don't. If you have higher highs and lower lows, it's just a messy market. And I mean, if you can see that before you start trading, just stay away from it. Okay. But and Wayne just said he finds the 7 range is kind of rough. Some days it really is rough. Some days it can be really rough. But right here, for instance, we had some nice trending movement right here, and then it pulled back pretty deep. I mean, it was putting in it had lower highs and lower lows, so it was a pretty nice trending movement right here, but then it went sideways quite a bit in here without going down, and it failed to put in a lower swing right here, so that was really trend change area right there. Does it matter the size of the range bar? 100 had a lot. It doesn't really matter the size of the range bar, Ronnie. 100, you still have chop on those, but most traders are going to get what they're looking for within a single bar or 2 bars with that. So it's not going to be, you're either going to be in the trade and get what you want out of 1 or 2 bars with 100 range, or, you're not going to be in the bar for 13 bars or 15 bars like you are with this. Maybe 30 bars like you would be with this. So the size of the range, it may look like it's less chop. It's still the same chop. It's just bigger chop. I'll show you that in a minute. Okay, but I mean, the thing is, your expectations out of the trade are what make it different. Like if you're only looking to get, let's say you're looking to get 100 ticks, and you're on a 100 range bar, you only need 1 bar length. You know what I mean? All right. So on the triangle chop. So in here, you had some really nice trades. If you were trading with the trend, like if we put on the TV trades here and we go and we put the buy sell area on here, all right. So it's all red in here, and you're only taking the shorts when it's red, and that's fine. Up here where the white goes into the overbought, and you get these. One of the features, I don't know if you guys noticed, one of the features that I added that you guys requested, that one of you guys requested, was to give you the ability to change the color of these things. I know I screwed up one of the words on this, but the bar color, where did I do that? Oh, that's down on the bottom. I did it down here. The bar color is down here. To change the bar color, oh, here it is right here. Optimum long bar color. So if I wanted to do a black bar on long trades and a red bar on short trades. Okay. So in here, when you're in a red background, you're only interested in the red bars, right? Shorting on the red bars. And when you're in a blue background, you're only interested in the black bars. This doesn't look like it's right, but it is, I think. Yes, it is. That's the way it is, right? So when you're trending like this, right? When you're in here and you're trending, and you're looking for the shorting opportunities, you're looking to short when it goes up into the overbought. If the white goes up into the overbought, like this one right here, where the white went up into the overbought, if you're trading with the trend. And that's where you're going to get into the triangle thing. The triangle thing is going to start out in a trend. You're going to have lower highs and lower lows to begin with, but then you're not going to get the lower lows anymore in this case. Okay, it's going to change so that you don't get the lower lows, but you have the lower highs, and then you start getting higher lows. And then your expectation changes, right? Because when you're in here, let me shut that off for a second and show you what I really want to show you. Here. When you're in this space right here, you're expecting, when you get into trade right here, you're expecting it to get down to here, and once it gets down to there, you're expecting it to actually go even further, right? You're expecting, this is your leg length. From there to there is your leg length, right? And here's your pullback, 50%, roughly. And you're expecting another leg length like that. So you're expecting it to get down to here somewhere, probably, right? This moves down to here, from there to there. Now, I'm drawing this rough. I'm not doing exact, but that was pretty close, from there to there. Right? Maybe it wasn't that close. You're expecting it to get down to there, but you see it doesn't reach there. And that's when it doesn't reach there and it starts to pull back up, but it doesn't give you a higher swing. Then you have your lower swing. I mean, your higher low right there. That's when you get into this triangle chop. So now you're in the triangle chop, and that's okay, because you have an area of resistance right here that you can trade up to, and you have an area of support down here that's rising, but you can see what the area of support is like. So if you're getting trades off of the bottom, you can expect that they're going to go up to the top, and if you get a trade at the top, you can expect that it's going to go down to the bottom. So this is the second best type of chop to trade in. If you're in a triangle like this, when I say trading in chop, if you're using the optimized trigger, that works great in chop. And if you're using the divergence, now the stuff that I do in the morning is more like this, okay? It is more like this, that one and that one. It will make this a line. So we'll get rid of that and use that. And let me shut off that. Okay. Go back here. Did I put the password in there? I did, okay. Go back here, and we want to have the snipe on there, and we want to have this. Alright. So this is what I do in the morning. Alright. This is what it looks like in the morning with what I do. It uses a different thing in the morning, but the black line in here is pretty much like the thing that I do in the morning. What I look for is divergences, right? I look for the blue to get away from the black, to go into the overbought without the black, or to go into the oversold without the black. That's what I look for when I'm taking the trades in the morning. Like if you go back and look at the trades that I took earlier here today, you can see that there was divergence right here. And if I had the overbought and oversold lines on, you can see this blue went into the oversold without the black, and that was a trade. It did it again right there, and that was a trade. It did it again right there, and that was a trade. This one, it looked like it did it again, and that was a trade. And this would have been a trade, and this would have been, actually that didn't go in. This, no, that was about it. But over here, this was a trade. This is what I do in the morning. I look for those divergences. Okay. I just wanted to show you that because some of you guys may be curious about that. If you've never seen what I do in the morning, that's what I do in the morning. So the one in the morning it doesn't have any color in it. It's just really watered down. It's not as good as what we do in here. Right? If I put this back on now, then you have everything in here. Now what I do in the morning is great for what I do in the morning is great for the chop. It's great for the chop, but it's not good at all in trends. What we have in here is good in everything. Okay. So, I thought it was important to cover that. With the optimized trigger, it's good in every kind of market. The one that I do in the morning, the divergence, that's not work well when you're out of chop. When you're in a trend, it doesn't work well at all. When you're out of a trend, when you're in a trend, because you get a lot of flat spots in a trend. And that's something else that I want to go over with you in a minute. I should make a list. What time is it? It's 3:32. I'm halfway through already. Well, anyway, I want to show you this, right? When you get into a position like this, you have resistance right there. So you can trade. If you get a long trade, you trade up to that resistance. If you get a short trade, you trade down to the rising support. All right? That's what you should do to know what to expect out of the trade. With the Bugle type, you don't know what to expect out of a trade. So you just got to trail your stop really close. Use the prior swing high is a key. Use the price action going with the prior swing high is a key, but you don't know what it's going to do. You don't have an area of resistance that's really established or an area of support that's really established. That's why I don't like trading when you're in that kind. This kind right here you can trade in, and it's pretty good because you can see where it's supposed to go to when you get into a trade. All right, and if it gets there, this is also the prior swing high. It got there, you would expect to find some resistance there. That's great. You just take profit, get ready for it to turn around, and right there it did. So I had a long trade from down here that said, look for it to get up to here, to the resistance area when that was dropping down. And it did. It got up to that resistance area, got up to the prior swing high. At that point, it also gave you a short right here saying take the short. And that said, look for the rising bottom. And it got right down to that. Okay? That's why that kind of chop is better than this kind of chop to trade in. This kind of chop, just avoid if you can. This kind of chop is okay to trade in. You should get decent results in that kind of chop. But my favorite kind of chop is this guy right here. Because you know where the top is and you know where the bottom is. Look at all the trades I took in this chop. Now, I was using the divergence this morning, but a lot of them match up. Like this one right here matched up just fine. This one had divergence this morning. It doesn't match up with this one, but this one, see, the divergence wouldn't have worked on this one, but it matched up here for a short trade you could have taken. And this matched up for a long trade you could have taken, but it didn't have divergence this morning. And the divergence matched up on that one. It matched up on that one. So if you get into this channel chop like this, keep your expectations for the trade small, but take profit. I mean, look for the swing high. It's trying to get to the top of the chop and then back down to the bottom of the chop. And with this kind of setup where you're trading when it goes into the overbought, when it goes into the oversold, you're able to get in at the top and get in at the bottom, get out at the top and get out at the bottom. If you know what you're expecting out of the thing because you're in this chop, you can put your profit target right here. You're gonna bump your stop to break even the same way you normally would. After 4 ticks in profit, you bump your stop to break even, but you have your profit target right there. So it takes you out at the profit target, and then you're ready to just turn around and go short and reverse it and go short right back down to the bottom. You see, I did that several times in here. I did it 4 times in this chop. I did it 3 times in this chop. And, that's just how it works out. Okay, now the trades that I took this morning, you can see these are all the trades I took. Like I started out with a break even on this one, then I had a good trade on that one. That's an overlap right here. This is the optimum trigger and the divergence trade this morning. This was an overlap right here too, but I screwed that one up. I stopped out on it, but I entered like way down here. I shouldn't have entered in that trade there. I had missed the opportunity. This was a divergence, and you can see the overlap on that. This was a divergence, you can see the overlap on that. This was a divergence, you can see the overlap on that. So these two right here, they look like they didn't go in the right direction, but they did. This went down 6 ticks, so your stop would have gone to break even, maybe locked in some profit. And this one went up 7 ticks. So it had some opportunity in there. This one right here, it was a divergence trade on top of the on top of that. I mean, if you really want to put the divergence on top of this, I don't think I let you put another line on here. I think when you're doing it this way, you'd have to put a whole other trigger on top of it with just the divergence line on it, and that would be the div area that is usually red and an area by default is what that looks like. Okay, but I changed it just for this example in here. But you'd have to put another one on top of this. You'd have to overlay another trigger on top of this trigger to make that work. But you don't need that. Alright, you don't need that. It's all built in. So these are the trades that I took this morning. You know, I can tell you what I got on each trade if you're interested. This first trade on the S, I just got 2 ticks. I stopped out on that. That put me at... Hang on. That wasn't the first trade. The first trade was back here. I got 2 ticks on that one. Then I had a break even. Then I got 8 ticks. That put me at 10. Then I stopped out minus 10. I was at 0. Then I went to 16 on that one. Then I went to 28 on that one. Then I stopped out again. These orange ones that I stopped out on, those were mistakes. So I would be, at this point, I would have been at 16, then I went to 28. I'd have been at actually 38 right there if I didn't stop out on the prior one. And then right here, I'd have been at 48. I'd still be at 38 right there, but I wouldn't have stopped out on that. I'd taken profit on that and taken profit on that. So I'd have been at a minimum at 38. But anyway, I stopped out on that, brought me back down to 18. Then here I picked up, looks like 14 ticks to get me to 32. And then I stopped out again. That was a valid stop out. That brought me down to 22. Then I got a little bit of a gain there that brought me up to 26. Then a couple of break-even trades in here. And then I went from 26 up to 31, then 31 to 39, then 39 to 40. And then I started trading in the chop. I went from 40 to 48, then 48 to 60, then 60 to 61, and 60 to 61 to 63. And that's where I ended the morning session right here. But there was just a lot of opportunity in there. Right, a lot of opportunity. And this is on the 7 range. You know, you can do this on whatever you want. Like Wayne has just said, you know, the 7 range is kind of tough for him. That's fine. Go to a bigger time frame. When you're doing the ES and the NQ, you should do a time frame that is multiple of 4 minus 1. Now, I say that just because it's going to be easier to see where the top and the bottom of the bar is going to be. If you're using, you know, if you're counting in your head, trying to figure out where, you know, where the top of the bar is going to be, where the bottom of the bar is going to be. If you do a multiple of 4 minus 1, you know where the bottom is. You know the top is going to be a certain amount of points ahead, above or below. Okay, but you know, if you go in here, you can see on the 19 range how many of these went 10 ticks or more, because that's where you'd be bumping your stop to break even on the 19 range. Okay. All right. So that was the kinds of chop, right? It is 3:39, so I have 20 minutes left to answer your questions. Does anybody have any questions about all the chop stuff that I just covered? Because I want to make sure that I cover all that well enough for you guys to get a feel for it. You know, I'll cover it again in future meetings, but identifying the kind of chop that you're in is step 1, all right? When you're in a trend and you stop putting in lower swings, like you're in a downtrend and you stop putting in lower swings, you're at the beginning of triangle chop. All right, and if it stops putting in higher swings and it stops putting in lower swings, then you're right in the middle of the triangle chop and it's decreasing, looking for a direction. If you're in this right here, the bugle chop, it's putting in higher swings and it's putting in lower swings, it really has no direction. Right, so you really don't want to trade there. In here, at least it's a narrow range looking for direction. In here, it's just this wide open range looking for some kind of direction. And when you have channel chop, that's great. It's got a range for you. It's got an area that you should be trading in. Okay. You could just narrow the trade to only taking the white line and overbought and oversold. That is the idea, Ronnie. If you do that, You can take the red off of here if you want. Oops, not there. This one, get the red off of there if you want. And just take the white bars, or whatever color you make it. When the white goes into the overbought or the white goes into the oversold, just take those trades. That's essentially what you're doing anyway. You don't really need to have the red thing on there. I'm gonna use that to do some other things in the future. Right now, when it gets off the middle, it shows one other potential thing. But like right here, right now, this has already gone enough to move the stop to break even, but it was a nice short from right here. All right, 66.50 is where you would have entered that, and it's already dropped down to 63. So it's gone 2.5 points. All right, 3.5 points. 3.5 points, 14 ticks right there. That's a good chunk of money. If I had 10 contracts on those 14 ticks, that's like $1,250, I think. So it's even more than that. It's $1,750. How about explanation of the red, black, and white lines in the oscillator? Okay, so let me go over that for you, Hal. The red line is the middle, okay? The red line is the middle, obviously. That's your midpoint. And when it pops up or it pops down, that means something else has happened in the background that doesn't figure in exactly to what's going on with the white and black line. What you're really looking for with this, you don't really even need to have the red in there. All right, you don't really need to have that in there. You can take that out if you want. What you're really looking for in here is for this to go through the middle and into the oversold, or through the middle into the overbought. All right, you want to go into the oversold or into the overbought and be white. Now the ones that actually change to white while they're already in the overbought and in the oversold, I got to change that. I got to fix that. That is one thing. That might be what you're talking about, Abe. Okay. But you see this one right here? I just told you, I thought it was 14 ticks. It was only 13 ticks it went into profit. These numbers that you see here, that's how far into profit it went on the bar that triggered the trade. Right? The bar before it is the signal bar. I don't have these signal bars turned on in here, but if I turn the signal bars on, oops, it's down here at the bottom. I always forget that. It's down here. Here. If I turn the signal bars on, there. Okay, so they're usually white by default, but the signal bar is the colored bar right here, and the bar after it is the trigger bar, the bar that you actually take action on. Okay, so when the white goes into the overbought, you want to sell the open of the next bar. When it goes into the oversold, you want to buy the open of the next bar. When it goes into the overbought, you sell the open of the next bar. When it goes into the oversold, you buy the open of the next bar. Okay, and the numbers that you see here are how much it went into profit on that bar alone from the open of the bar. So if you got your entry right at the open of the bar, then that's how much profit was in there. Because you want to have your entry at the open or better is where you really want to get your entry. Okay. At the open or better is where you really want to get that entry. And that's how you do it, Hal. It's a really, really simple process, right? When you see it's going toward the overbought, that's why the red line is in there kind of for that. So you can see, when it's at the middle and you see it's going toward the overbought, it just needs to give you an up close to get there, right? So you can sort of be expecting that. Be expecting it to get there. And there it is. Months of training for what, Joel? Is this really hard for you to understand? The white thing going, this line down here being white, when it gets into the overbought, you buy, and going into the oversold, you sell. I'm sorry, I said it backwards. Going into the overbought, you sell, and going into the oversold, you buy. There's things, there's things that I make the assumption that you know how to do. You know how to trade. You have an account that is open somewhere, and you know how to place a trade. All right? I don't have training for that because I don't know where your account is. I don't know what kind of trading you're going to do. If you're going to trade on a chart, if you're going to trade on a DOM. I don't know if you're going to call them and ask them to place a trade for you. But, so the assumption is that you're able to place a trade. You know how to place a trade. All right, now that may be a leap for some of you, but if it is, you just got to let me know. Okay. But yeah, I'll show you a trade right now. What time is it? Let's go to the. Well, here, let me just minimize this and we'll see if we have anything going on in any of these markets right now. Okay, so the divergence trades that I do in the morning, they look just like this. They don't look fancy like that, all right? There's a lot more work to it. And what I'd be looking for is for this right here on gold, I'd be looking for this to give me a down close. And if it gave me a down close, that would lead into the oversold, and I'd buy the open of the next bar. Now that, Joel G, that takes more thinking, and that does take training, and that is a whole different thing. That costs a lot more money, and it does come with training. The TV trade stuff, it doesn't come with training. That's why it is so much easier to do, and you get so much more information from it. Like right now, if I put the password in on all these things, and oops, I didn't do that. Is that right? Is that right? And I do that, and not conservative bars. I can see this is not it's not the updated one. But I'll just do the updated trigger. All right, it doesn't have the alert on it. But if I do that, I don't have the updated one in here on any of these. But I do that on all of them. Did that one not take? Oh, it's still calculating. Okay, and if I do that on all of them, paste. This one is the updated one. You see, it's got the alerts going to. And I'll just say okay on that. I want to get into the alerts a little bit for you guys too. So the white segment of the line is like the blue line going into the Aurora results. Yeah, that's what it's like, Hal, for what you're doing. So what you're looking for is like this one right here. You know, if you get a down close on this bar and it turns white, then you have a buying opportunity. If you get a down close on this bar and it turns white, on this bar right here, if it goes into the oversold and it turns white, you have a buying opportunity. Right? If this would have turned white right here, you'd have a selling opportunity, but it didn't, so it's not a selling opportunity. Okay? The turning white thing is what you don't know. I mean, you can get a pretty good idea of whether it's going to turn up or down, whether it's going to go up or down based on the close of the bar, but you don't know whether it's going to turn white or not. And that was one of the requests that somebody had on YouTube. They had asked me to somehow give them a warning. And I would like to. I've been looking at a whole bunch of different ways that I might be able to do that. But because it's only a couple of bars between here and here, you know, you would get too many notifications, too many false positives if I tried to do that, to give you a notice that it's going to turn. And Ronnie just said he took trades on the YM. He had opportunity on the YM. What range was that on, Ronnie? 19 range. Okay, so I can bump this to a 19 range. I'm sorry, I can bump this to the YM. Oops, I didn't mean that. I meant this. Just bump this to the YM and see. Because Ronnie said he just took trades on this one right here. Right here, he took a long trade right there on the open of that bar. So that is, I mean, that's a valid trade. And this right here is also a valid trade. I don't have a YM DOM open, or I'd take the trade right now. You know, you would go long right here at 551. I don't have a YM DOM open, so I can't take that trade. But if I got one on these other ones, I do have DOMs open on all of those. So I can take a live trade with you if we get the opportunity on any of these markets. I mean, we still have 10 minutes, so we'll probably get a shot on these other markets. With a 50 range on the NQ, I have a 60 by 75 bracket, 60 tick stop by a 75 tick target. And over here on the 7 range gold, and on the ES, when I have the ES on the 7 range, I'm going to put that back on the 7 range. That's what my DOM is set up for. When I have this, like right here on the ES, is a long trade, but it's too late to get into because it already went 7 ticks into profit. It would have been right there buying the open of that bar, okay? But it already went 7 ticks into profit. So you can't get into that one right now. And this didn't print that last bar, so we'll do that and that and see. Another one. We don't have another one. There's an argument for taking a trade right here on the YM again, but I don't have a YM DOM open, so I can't. This didn't turn white when it went into the oversold on the NQ, so I can't do anything there. But that's all you're looking for, really. It's not It's not hard to do. It's really easy to do, Joel G. There's nothing complicated about this. You're just looking for that to go into the overbought or into the oversold. And so we just had one right there on the YM. That's what Ronnie was saying. He did. And that was this one right here. I just gave that trigger, I believe. Alright. So I want to go through the questions. Yes, the trick is to stick to the risk management. That is true. You have to have a plan for your risk management. You have to have a plan. And you got to have something that you're going to do every single time. Even if you stop out a bunch of times in a row, don't change your risk management plan. If you don't have a risk management plan, you don't have a plan. You probably shouldn't trade live money at all. So right here on the yes, is a long trade. Is that the yes? It is the yes. Okay, yeah, I just put it on. Here it is. Okay, right here on the yes is a long trade, and I just put it on with 10 contracts. See that right there? Plus 10. Now after 4 ticks in profit, like that right there, I bumped the stop to break even, and it just took me out of break even. But that's the risk management. Okay, it says after 4 ticks in profit, move the stop to break even. It says it right here on a 7-tick range. 10-tick stop goes to break even after 4 ticks in profit with a 30-tick target. That just happened right there. Okay, right here on the gold has a short right here. Now gold market's pretty slow right here. I'm not filled on it yet. It actually went, the gold on the 7 range, it's already gone 4 ticks into profit, so I missed my opportunity on the gold. I'm going to cancel the order that I have on that. The entry point should have been here at 31.4, and it's already dropped down to 30.8, so it's already gone 6 ticks into profit. It's a 7-tick range, right? It's a 7-tick range. So the thing about the 7-tick range, it doesn't matter what market it is. You move the stop to break even after 4 ticks in profit. In this case right here, it's already gone 6 ticks, so it's too late. I didn't get filled. It's too late. The ES just gave another one right here that I missed. Right here, you could have shorted that right there for a good 7-8 ticks. Now 7-8 ticks with one contract, that's 87, $100. But with 10 contracts, that's a lot of money. That's $1,000 right there. I could have just made if I was paying attention to it. The YM's got another short right here that I can't do because I don't have YM down open. But you see, it's the same thing. ES last example went into overbought with only having up prior into oversold. It took 2 bars to get up there. Right here. It took 2 bars to get up there into the overbought. Okay. It always takes 2 bars to go from the overbought to the oversold. A minimum of 2 bars to get from overbought to oversold. Is that what you were saying, Daryl? Can I show your triggers settings so you can take a screenshot? Yeah, sure. This trigger right here, any trigger, right? Any trigger. On this side is what you're looking for, right? So you don't have to do the bar color because that gets overwritten for the most part. But if you do have the bar color on, it's going to have this. Now, the bar color for the long and short, by default, that is white, Larry. Okay, by default, that's white, so you have the white bars. And then that green bar in there I thought was painted by this, but maybe it's not. That might be my TV Trades up here. TV Trades has a bar color. Hang on, I'm going to undo it in a second. Okay. I'll put it back so you can see it. Here's the settings on the TV Trades range trigger, if you want to take a screenshot of that. And I'll give you the settings. I'll give you the settings. I'll give you the settings in a minute for the other one. Did you get that one, Larry? How can you know which kind of chop it's going to be? Yeah, I wish you could know ahead of time what kind of chop it's going to be. You don't know until it's actually doing it. Okay, that's what the whole reason I pointed that out is so that you could recognize what kind of chop it is. So you can see what kind of chop you're in. I mean, you can't say, okay, well, this is going to be channel chop next. You can't say that. But I'll answer your question with something else. This is, did you want to see this one too, Larry? Did you want to see the TV trade side too? Because on this, I don't really do anything except turn on the beta right there. And down here, I got to fix the wording on one of these. I have 2 bull triggers, and one of those should be a bear trigger or something like that. I gotta fix the wording on that. I got that a little mixed up. Okay. Your optimum bar color doesn't have long and short option. You gotta refresh it. You know, take off your TV trays range trigger and put a new one on. Refresh your chart. Okay, if it doesn't have that in there, if it doesn't have it in here, that means you have an older version. Okay, the bar color thing. Wherever that was, this one right here. If it doesn't have that long or short, and you only have the white, then you have an older version. Just go and reset. Okay. Now, what you get is a little purple circle. If it needs to be updated, there'll be a little purple circle on it that says there's an update available. Okay. Now right here, the YM's got another trade that I can't do. The gold had another trade there that I didn't do. But you can see why there's so many trades available. There's so many trades available, day after day after day. And that's how, you know, this morning, like in here, if we look at the gold, we have all the trades that I took on gold today. We're in here as well. Okay, there's a break even and a stop out. I didn't have that many trades in gold. But a break even, a stop out, profit. What did I end up with gold? And I actually had a bad day in gold. I was minus 20 in gold. I stopped out there, and I had a break even there. That wasn't all the trades that there were, but those are the trades that I took. And again, they were divergence trades. They weren't the trades that you see here. Okay, because like that doesn't match up to anything in here, does it? Yeah, I guess it does. But there was a trade here that would have gotten profit. There was a trade here that would have gotten profit. 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 So this is better than what I do in the morning. But the morning is not TV trades. Okay, that's what I did in gold today. And you saw the ES. I didn't do anything on the YM. I was down on the Russell. I did show you the Russell. In the NQ, I was up on the NQ, 277 ticks today. We had some big trades on the NQ this morning. We did stop out one time, but right in here we had some nice trades on the NQ. Started out, our very first trade on the NQ was 75 ticks. Then we had some small trades, a couple of small trades, and then we had another 75 tick trade. Then we stopped out, and then we had another 75 tick trade, and then we had some smaller trades and a couple of big trades. But it was good trading on the NQ today. Let me go all the way to the end. That is strange. Okay, this doesn't look like here. That I think is what we need to put on there. Move that out of the way and minimize that. There we go. Alright. It's 3:58. Man, where does the time go? The white line on the range trigger. What do? The white line on the range trigger? White line with the red line? You can ignore the red line for right now, okay? Just ignore the red line for right now. You can take that off if you want to. But if you have a white line, just react to the white line. Okay, Daryl, you got that? Good. Your optimum bar color. Okay. Damn, Joe. I think I answered that right. And Joel, how can you know which kind of chop it is? That's why I showed you the different kinds of chop. If you take this right here, you don't know what kind of chop it is until the market actually does something. That's why I was saying with this is the worst kind, because you end up stopping out like once or twice before you realize that it's doing this. This is pretty easy. You don't stop out at all with this. You just see it, that you're not putting in lower swings. You're not putting in lower swings at all. You have lower highs and higher lows. You can see that. Okay, and this is the best kind of chop, and you can see when that's happening too. You know, when it begins, you can see that. And usually this kind of chop happens after you have a big leg up or a big leg down. You're usually going to get the channel chop, and it happens more frequently than any of the other kind of chop. It happens after a big leg down or a big leg up. The triangle chop happens, I mean, I can't tell you exactly when it happens, but usually it happens when you're in a trend and you get near the end of the trend. This doesn't usually last very long. This stuff up here, when the market is just meandering and it's got no direction at all, this doesn't happen all that often, and I don't like it when it does happen, but it doesn't happen all that often. This is the worst and the least often. This is probably the second best and not as often. This is the most often, and this is the best kind of chop right here, and the most often that you're going to get. And this, again, if you want this, you can email me for it, or you can just go out here to targetviewtrades.com. I don't know how many of you guys know about targetviewtrades.com, but there's a ton of stuff out here. Like these meetings that I'm doing, They're all out here. If you go to upcoming and past webinars, all the meetings that I do get put out here. I mean, this was last week's, and the week before that, and that, and that, and that, and that, and that, and all the ones before that, going back, for a very long time. All the meetings are there. So that's where this meeting is going to be later today. It'll be right here. All right. I don't have one scheduled for next week, so I'm not going to have something for you to click on to go to next week's meeting. I'll just put a placeholder up there that it's not next week. It's going to be the week after. It'll be the 12th. All right. It'll be April 12th. No, it'll be March 12th. I'm sorry. It'll be March 12th. That's going to be the next meeting. So I'll just have March 12th, and I'll have a thing there to sign, to register for it, but it's not going to have what the meeting's about because I haven't figured that out yet. So if you want to register for that. But this page right here, it's got a whole bunch of stuff. Like if you don't know like how to get real-time data for TradingView, watch this video, the setup video right here. 2 minutes into this shows you how to get real-time data for TradingView. It shows you how to get your charts. This is all about the sniper, the alerts. This is all the other kinds of alerts. This doesn't include alerts about the optimized trigger, okay? But in here, if you look at the risk management, this has got this stuff and this document. You can download this document right here. Download it as a PDF if you want to. All right, and there's under here, under instructions, instructions for using TV trades, and under more, the other types of things like the mid-trend trade and the just a regular trading view on the TV trades, arrows that happen at the beginning of the trend, the bias level, the targets, the warnings, the table, all that stuff. These are all videos about different things that you have available to you if you want to go look at it. Now, obviously, the most recent thing is the TV trades, the optimized trigger. So that's where I got most of the focus right now. But I'm working on like 100 different things at once. Seems like all the time. So I'm always trying to make it better because you all know that I trade for a living. And all right, it's 4:03. I want to make sure I answered everybody's questions. The one guy that I'm not sure, Joel G. Did you have any questions that I didn't answer? Because it seemed like in the beginning you had some questions or some statements that you might have needed a little more direction on. And Abe, Shahab, your NQ 50 range chart doesn't show any bar profit. No, yeah, I know. I'm working on that, Shahab. I'm going to see if I can figure out why that is today, because it's on all the markets. It's not just on yours, and it's not just your charts. It's all of them. Okay. But we've gone the full hour now, so I like to keep it. I like to keep it to an hour. I don't want to run this thing over too long. So like, some of the meetings that I end up in, they start 15 minutes late and they end up running over, 45 minutes. I'd rather not do that. Can I explain slippage? I can explain it. Well, slippage happens when you go to get into a trade. And let's say you have a buy stop limit order. We'll say, like, let's say I put a buy stop limit order right there, and price came up, and there was something that happened in the market that really had a lot of movement in the market, and it would hit me right there, even though that's a limit order. It could hit me right there, and it could fill me up here a couple ticks away from that, or with 10 contracts on. I don't necessarily, I seldom actually always get 10 contracts at the same place. It usually spreads it out over a couple of ticks. That's what slippage is. It means you get your fill near where you want it to be, but you don't get it exactly right there because your order gets spread in with all the other orders, and it doesn't always get exactly where you want it to be. It is much worse if you do market orders. If you were to do a market order, a buy market, a sell market, you get slippage. You guaranteed slippage on that because you go beyond all the other limit orders that may get slipped. Then the market order goes after all the slippage that happens on all the limit orders. Then the market order goes. So you're guaranteed slippage with a market order. So I use buy stop limits, sell stop limits. I always use limit orders. Okay, always use limit order. Okay. Jill, you're not in here right now, are you? No, Jill is not in here right now. Okay, that's what slippage is, Joel. Alright, any other questions? I'm going to stop the recording here, and I'll still answer questions for you if you have them. Okay, I'm just going to stop the recording here at 1 hour and 5 minutes.